Listen, thank you, everyone. It's great to see you all. My name is Mark Miller. I'm a senior advisor at ODI, along with various other hats these days. It's always a great pleasure to come back to ODI, to see various old friends, faces, new friends. It's always a great pleasure to come back and see my photo, which was taken, you know, a couple of hours ago, I think. So, yeah, no, it's great to be back. So to the session. So over the past day or two, we've heard about various types of shocks. And I think much of the emphasis, perhaps unsurprisingly in a public finance conference, has been around various fiscal policy measures that can be taken to counter those shocks. So we've heard about things like, disaster insurance, contingency budgets, financing social insurance schemes, public investments in resilience. But I think there's also a school of thought that would argue that while sort of fiscal policy choices are, of course, important, that many of the root causes of vulnerability in lower income countries are more structural and related to economic structures. And a particular manifestation of structural vulnerability, if you like, is that lower income countries tend to have exports concentrated in one or two sectors, which leaves them exposed to shifts that often as policymakers they can't necessarily do a lot about. So in this session, we're going to be exploring further these structural drivers of vulnerability, and particularly the scope for export diversification to address that in terms of building resilience. And I'm delighted to introduce the panel who's going to be talking about this with me today. So joining us online, we have Jose Antonio Ocampo, who is Professor of Practice at Columbia University, but previously Finance Minister in Colombia. Welcome, Jose Antonio. We have here in the room, Rebecca Simpson, who is an economic historian at the University of Oxford. We have Constant Lonken Nguana, who is a Deputy Division Chief and Mission Chief for Madagascar in the Africa Department at the IMF. He also leads the Diversification and Structural Policies Network at the Fund. And we have Tedros Mekonnen-Gebrolda, who is a Senior Country Economist at the International Growth Center in Ethiopia. So welcome all. I'm going to start by bringing you in, Jose Antonio. I recently read a paper of yours, which actually really kind of changed the way that I think about economic resilience, where you talk about this idea of balance of payments dominance. Can you describe what you mean by balance of payments dominance as a macroeconomic regime, and why you see the balance of payments and exports as being so critical to resilience?
Well, thank you very much, Mark, and thanks to be this meeting of ODI. And of course, in the panel with the very distinguished participants. Let me say that this concept of balance of payment dominance is a concept that I developed as an alternative to what they call the concept of fiscal dominance, which is very much in macroeconomics. The basic point that is captured in the concept of balance of payment dominance is essentially that the balance of payment balances, let's say, are very critical in the dynamics of developing countries. Basically how to manage booms and how to manage busts in the balance of payments or external shocks, let's say, positive and negative. They come from two different sources. The first one is basically the terms of trade, which is very important for commodity exporters, which is the majority of developing countries, notably in Africa. And the second is let's say the capital flows, which are very pro-cyclical for all developing countries when they come from the private sector. Hopefully the multilateral development banks and the IMF will play a counter-cyclical role. But when you have access to private capital, it is quite procyclical. That is, in good times, you get a lot of availability of financing at reasonable cost. But when the crisis comes, you get no financing or very limited financing at a higher cost. The basic problem in this case, or in both cases, is you didn't manage well the boom. You're having a trouble managing the bust. So let me, for example, go into the particular issues. The first one is commodity exports and what should be done. So if, of course, when you have a commodity boom, the domestic demand will increase, and that will support the recovery of economic activity at home. But when the opposite takes place, you have the opposite effect. So you have a cyclical effect associated to the commodity prices. Now, in that case, again, the best option is actually to save money during the boom. For example, a commodity stabilization fund that saves money during the boom in order to allow that fund to be available during the crisis. This can be done basically by a contribution of commodity producers to that fund during the boom, and then let's say a subsidy or support from the commodity fund to the producers. For example, in my country, Colombia, that was very well developed for the coffee sector in the past. Actually, it's in the 1940s. And it was quite actively used for several decades. Now, there is also the question in the case of exports of the exchange rate management. So if during the boom you allow the exchange rate to appreciate, or you have domestic inflation that generates a real exchange rate revaluation, then of course you will have less incentives, particularly for export diversification, a topic on which I will come back. And therefore that effort to diversify export may actually weaken and make you more dependent on your commodity for your export earnings. Now, in the case of the capital flows, a major problem is that the public sector, and of course, when you have a commodity boom at the same time, the fiscal sector, the government, will have a lot of revenues, and therefore the capacity to increase spending. If you have access to financing, that means even more spending. So it's a procyclical effect on government spending, which also implies rising debt, public sector debts. So when the crisis comes, you may be forced to reduce spending, and particularly you have to incur in an adjustment program, for example, with the IMF. So you have austerity policies, and on top of that, you may be forced to manage a problem of over-indebtedness without the international support that is generally not available to support. I mean, I was in a conference in Ghana last year about the African debt issues, which is a major problem, which is the record of the access of several countries to private financing since the global financial crisis due to the low interest rates that characterize that period. Anyway, so that's the basic point that, and therefore you have to be prudent in fiscal spending during the boom in order to avoid over-indebtedness on the one hand, but also to have resources even to be able to avoid the excessive austerity during crisis. Now, in relation to the panel, since you wanted to focus on exports, let me say that, of course, what this implies is that let's say the promotion of new export sectors is a very important point from the point of view of economic stability. both in terms of growth, of course, because you develop new sectors that will support your economic growth, but at the same time, to reduce the vulnerability to these commodity price cycles that can generate. Now, what commodities? I mean, it's a big question mark, or excuse me, what export sectors? It's a big question mark. First of all, you may do a lot with commodities, particularly, for example, if you are a food exporter, that's something that is quite appreciated at the international level. But you can also do, for example, alternative mineral products that are good for the energy transition and the digital economy. I mean, those are possibilities. But even with the very traditional sectors, there is a possibility, of course, of improving the productivity and being more competitive in the production of traditional commodities. Okay, manufacturers. Well, there is a question mark that Daniel Rodriguez has made about that. But I think there's a possibility, at least, of starting with low-skilled manufacturers and then promoting higher-skilled manufacturers. Okay, let me stop for the time being. Thank you.
Thank you, Jose Antonio. I'm not sure if you can hear me okay, but thank you so much. So I heard three things that you talk about. One is this idea of fiscal stabilization, so saving in good times. A second thing I heard about is the role of the exchange rate and the role that the exchange rate management plays, particularly during sort of boom and bust. And third, we started to get into this the idea of kind of potential sectors for promising export diversification. I'm sure towards the end of this discussion, there's going to be some questions that come up about, export diversification in today's world, given the, some of the fluctuations in global trade policy, if you like. But perhaps what I would like to do, if it's okay, is go on to Rebecca, who's going to talk a bit more specifically about Africa. And in fact, Rebecca wrote a very good blog that I'd like to draw your attention to about how Africa could get off the, I think you called it the commodity roller coaster. So perhaps you could tell us a bit more about that blog. I think she's got some slides to share. And yeah, over to you, Rebecca.
Might be a bit of an occupational hazard, but I don't feel like I can go anywhere without some slides and some nicely well-placed figures, hopefully. So hopefully my comments will sort of add a bit more illustration, perhaps, to some of the ideas that Jose Antonio put forward. So I'm working on a sort of new research project where I'm hoping to provide a bit more of an economic history perspective on Africa's lost decades, so the 1980s, 1990s, and to think a bit more sort of descriptively about sort of what happened and why. So my comments are very much sort of from that perspective and informed very much by that particular commodity price bust. So it's fairly high level, and I'm not really in the sort of policy weeds, if you will. But I thought I would start with a figure I find sort of quite astounding, that just sort of looks at Africa's sort of aggregate growth path relative to the global commodity price cycle. So the orange is an index of commodity prices, and the blue line there is GDP per capita for sub-Saharan Africa, population weighted. And you can see that there's a sort of strong co-movement here, right? And this period of the lost decades of Africa's really severe growth collapse very much coincides with this long-run period of declining commodity prices. And perhaps not surprisingly, then we do see this very strong period of growth as commodity prices recover. So this was a particularly large commodity price swing. But what I want to emphasize is that commodity price swings are not sort of unique in history. Right? So looking back over the last 150 years, there have been many of these fairly large commodity price swing. And this is a sort of feature of commodity prices. There's quite a large literature about sort of why and what they mean. The one in the 70s to 1990s, early 2000s was very driven by oil prices. So that's partly why these swings are so extremely large. But you had a very large commodity price sort of cycle in during the First World War and the Great Depression period, and also one in the late 19th century. And during these sort of bust periods, right, if we're looking at these medium-term cycles, there's a lot of co-movement between commodity prices as well. So not all commodity prices were falling at the same time, but a lot of particularly African commodities were sort of all sort of falling, at least over that sort of longer time period. So I think that is an important point to raise for when we're thinking about export diversification as well, right? To have sort of more products in your export basket, but of a very similar type, doesn't necessarily protect you that much against terms of trade swings, right? So producing cocoa and coffee versus just producing coffee might not matter that much, at least for these types of longer term busts. So I'm very interested in then thinking more about these medium term swings than the sort of short term fluctuations. And one other point to make then about the medium run commodity price cycles, or I should say commodity prices in general, is that they're hard to predict. Okay? Many of you have probably seen some version of this figure before. This is the World Bank's forecasts of copper prices over time, the dotted lines, right, relative to the actual copper prices. So I don't want to suggest that I have any kind of insight about what's going to happen to commodity prices in the future. What I want to emphasize, right, is that it's not implausible based on a historical perspective to think that the world could experience periods or longer term periods, right, where a lot of commodity prices are falling sort of together, right? And countries are faced with these kind of recurrent shocks. And this has very, I think, profound effects, and they're a bit different. How you'd think about this is different from how you would think about the sort of short term volatility. So just to say then that this last time round, if you will, the repercussions were really severe for Latin America as well, but I think particularly for sub-Saharan Africa. And what did this commodity price shock do? I mean, to a large extent, it really put a constraint on foreign exchange earnings and on the capacity of countries to import. And that, I think, had very strong constraints, really constrained growth. On the left-hand side here, you see a chart that's looking at imports per capita in constant US dollar terms. So this is sort of median index here for sub-Saharan Africa. And from peak to trough, imports per capita fell by over 60%, right? This is a long-term sort of continuous or slow sort of decline in the capacity to import, would really put constraints on growth. African countries are also often very reliant on trade taxes. So this also had a very big impact on government revenue and government expenditure. And in many countries, government expenditure in real terms per capita or even in GDP terms, right, fell very, very dramatically. Also another way, I think, in which this crisis affected growth. So the second point I want to make then is that while building buffers is, I think, certainly sensible advice for commodity exporting countries, I think there's a limit to what we could expect those buffers to sort of do in the case of a more sort of long-term cyclical decline in commodity prices. And I think it's unrealistic to expect low and lower middle income countries to be able to sort of save enough to make it through this type of crisis, to really stabilize just based on sort of savings, if you will. So this is just a sort of back of the envelope simulation. I just looked at Nigeria's export earnings and its imports over time. And just assume that if Nigeria had saved sort of half of its windfall earnings in the 70s, so any sort of gains in exports after 1973, sort of save half of those. Assume they have some return to those savings, and then you try and, once prices start coming down, you try and sort of stabilize your import cover, right? How long could Nigeria have sort of stabilized its ability to import goods and services? So I find, just very, very simple calculation, right? But they could have stabilized imports for maybe 6 years or so. I think saving half the windfall is probably quite unrealistic, given the political economy pressures there's going to be on a low-income country to spend in the present. If you lower that to sort of a third, I think it would last for maybe 3 years. So it's not that these buffers aren't important, but they're not. I think there's going to be very strong political economy constraints to saving enough to get you through more than sort of short-term blips. And that was really the main focus of the blog. So in a way, where that leaves us, right, is that export diversification is really key to building resilience in the longer run against these types of longer-term fluctuations. And where I thought I'd end then is just with a few very sort of scattered reflections on sort of opportunities and vulnerabilities in the sense of how they've shifted since the late 1970s, 1980s, again, with the sub-Saharan African focus. So starting with some more sort of negative news, perhaps not news, to you. I mean, on many measures, African export baskets actually more concentrated today than they were in the 70s in terms of the number of products that the countries are producing. I think this figure kind of helps show why. So this is from forthcoming work by Ewald Frankema and Felix Meyer-Selhausen, have this nice paper on what they're calling Africa's mineral transition. And you can see, right, how important oil has been to sort of overall sub-Saharan African sort of export basket, if you will, and also shows you then the extreme vulnerability to oil prices, right? I think about 50% of African countries now produce some oil. And there's been a very big decline in agriculture as a share of total export value, which I think is an important point to raise as well. So this, I think, is a major vulnerability, and why I think we do need to think about price shocks that could potentially last for more than just a year or two. You might be thinking about services as an alternative. This is just looking at the sort of goods side, the commodity side. I think there probably is really interesting work to be done on service diversification in sub-Saharan Africa, but we're not really seeing any sort of major trend in the direction of sort of increased sort of services as a share of total export and services, at least based on the official statistics. So the residual here, right, would be roughly services as a share of exports and services across sub-Saharan Africa. So that's kind of the less optimistic perspective. As a historian, I think the most important shift, and the thing that probably interests us the most since the 1970s, 80s, is really demographic shifts, though. So sub-Saharan Africa has had very rapid population growth. Population densities are increasing. Urbanization rates, we've talked a lot about cities already today, right, are becoming increasingly important, while the rest of the world's population growth is slowing down. Right? So we should expect this to have a lot of ramifications, both political, economic, creates vulnerabilities, but it also creates opportunities. From a historical perspective, we would expect growing population densities to reduce the relative cost of labor in sub-Saharan Africa relative to other parts of the world. Right? So all else being equal, we would expect that, at least in the longer run, this would make sub-Saharan Africa more attractive as a sort of site for investing in labor-intensive manufacturing, or perhaps labor-intensive other forms of activities, perhaps more cost competitive, right, relative to Asia. But I think there are some sort of big buts here. Right? This is quite an old figure. This is official minimum wage levels in Asia and Africa compared from 2013, from a paper by Ewald Frankema and van Bijenberg. There are obviously issues with using official minimum wages, but just gives you a little bit of a feel. So as of 10 years ago, at least, right, many African countries still had minimum wages that were above those in South Asia, and lower labor productivity, right? But there were some countries in Africa, like Ethiopia, where the wage gap between Asia and Africa has been growing, and where you would think that it might be sort of possible to compete on the basis of inexpensive labor for manufacturing or other types of labor-intensive activities. But I think the big but here is whether or not Africa has sort of missed the boat on this, and the increasing sort of capital intensiveness of manufacturing and the reduced employment that manufacturing firms now have means that even if they transition more into manufacturing, it won't have the sort of employment implications that sort of Asia had during its industrialization phase in the 70s, 80s. So I'll stop there, probably over time.
Thank you so much. That was a fantastic sort of longer term, long durée perspective on prospects for export diversification and sort of links to the commodity price cycle. Oh, sorry. Do you want to come back? I won't bash your microphone out of the way. I'm going to come to you now, Constant, who I guess are looking very much, I mean, this way, this way, this way, this way. Okay, good. You can hear me again now. Constant, over to yourself. You know, I suppose you're currently what the African Regional Economic Outlook must be coming out quite soon. How does sort of Rebecca's long durée perspective compare to how you see the economic landscape now and the role of export diversification?
Thanks, Mark, and quite a broad question. Good morning to everyone, and thanks for joining, including those online. Yeah, Africa is a very, the story varies across the country, and to the theme of today, when you look at resource-rich intense countries, the experience is completely different from slightly more diversified economies. We had a study last year in the Regional Economic Outlook for Sub-Saharan Africa that showed that resource-intense countries over the past 10 years grew about half of the more diversified economies. So there is evidence that, you know, diversification more broadly, not just export, can boost growth. But I mean, even when you think about welfare, right? When you're thinking about consumers, you want some level of stability in your income flows. And if you're relying on single source of income, of course, if that sector is hit by a shock, your revenue would be impacted more. And if you have a more diversified production structure, then if sector A is not doing so well, sector B could help you smooth out your consumption. So beyond the level, because we talked a lot about level of growth, but there is also the stability angle, right? Where, you know, in terms of welfare, consumer wants some level of stability. Now, in Sub-Saharan Africa, of course, there are a lot of opportunities, and Rebecca mentioned the youth population. So there are a lot of expected dynamism in the region. So it's not all gloomy. We also, as I mentioned earlier, there are quite a bit of diversification going on the continent, and Sub-Saharan Africa is home to some of the fastest growing country on the globe. So there is that nuance that we would need to keep in mind as we think about Africa. But having said that, right, there are a lot of vulnerabilities, including in terms of fiscal space, still very narrow, and Antoinette laid the foundation very clearly yesterday during her talk. You know, the domestic revenue mobilization still very low. Debt levels are stabilizing, but when you look at the cost of servicing debt, which your revenue base would help with that, it's still very high, with 1/3 of the countries at high risk of debt distress. So although there are positive signs, there are still a lot of vulnerabilities that our countries need to work on. Now, coming to the issue of, you know, export diversification, as you may be well aware of, when we have lending arrangement with countries, we come at it from an angle of balance of payment, and Professor Ocampo nicely laid out the framework to thinking about that. And in that context, when you think about financing flows, and you're thinking about the BOP, you have balance of payment, you have the goods, transaction side, but you also have the financial side. When you're thinking about ODA coming down, you're thinking about financial flows, private financial flows, quite unpredictable. So you're left with very little. So, there is really an onus on ramping up exports, right? Because obviously, as those economy develops, you have two pressures. One is, of course, you need to invest. There were a lot of discussion about infrastructure. All those will lead to imports. Consumer habits, right? As people get more income, they would aspire to more sophisticated consumption basket, which would also add pressure on imports. So what you really left with as lever to maintain external viability is really to boost your exports.
So you're saying that boosting exports is very much central to, I guess, the IMF's goals of sort of stable economies, but also increasing welfare. And how do you see the IMF's role in supporting export diversification? I mean, if I was to be sort of slightly provocative, I sort of read fund reports where there'll be very detailed recommendations on fiscal governance changes, but some of the discussion around exports can feel a little generic. Improving the business environment, how do you see the fund's role in supporting export diversification? Does it have a role? Is it role evolving? What's your perspectives on that?
Yeah, good point. And you mentioned earlier when you were introducing the panel that we've talked a lot about fiscal policy, and it's time for us to talk about the external sector. But really, the way we think about it and how we engage the country authority is the two are really much linked. And the reason why we go on the fiscal side is that that's where also you have more discretion in terms of what policymakers can do. But there is a natural link, and you may, aware of the twin deficits, where everything that happened on the government side will spill over into broader external environment. So the issues of balance of payment, fiscal discipline, and all those concepts are really much linked. And when it comes to our engagement with member countries, we don't just look at fiscal. I know the fund is very much known for fiscal adjustment programs, but if you look at most of the lending arrangement we have, you would see mention to laying the foundation for sustainable inclusive growth as kind of the ultimate objective, right? And fiscal management and others are really just also a vehicle to reach that more broader goals. And our lending arrangement do have targets and so on, quantitative targets, but it also comes with strong structural reforms. So there is a quantitative side of those arrangements, of course, but also more qualitative and structural reform embedded as part of the arrangement that we have with countries. And on those, we really rely on countries also in terms of their ownership. And Antoinette mentioned ownership as being really a key, right, in driving those reforms. So we can drive, in partnership with our member countries, see what the country needs and what type of social contract is in place, and see how we can draw from other countries' experience to support the agenda.
Perhaps one final question before I move to Tedros. I mean, I suppose one of the areas the policy areas that there's been sort of active debate in recent times is around the extent to which the state should intervene to support export promotion. Historically, I suppose the fund has been, again, associated with quite a laissez-faire perspective on this, been quite sceptical about the role of industrial policy. Clearly, some of the IMF's leading shareholders take quite a different perspective on that in recent times. I'm wondering how the fund's views on industrial policy are evolving and how you're engaging with your members, particularly lower income members, on industrial policy questions as a way to support export diversification.
Yeah, very topical issue, and the fund has done quite a bit of work on industrial policy over the past 2-3 years. In fact, our World Economic Outlook has an analytical chapter on industrial policy. It was published Friday, so might take a look. There really, I think there are reasons that policymakers advance in getting into industrial policies. Those reasons vary, right? And the devil is always in the details, right, in practice. And what we found, maybe 3 lessons. Number one, IP, the chance of success of IP are higher when they are complemented with broader structural reforms. Because really IP, what you mean is literally you are picking sectors, right? You're trying to boost specific sectors. But this work, the chances of success will be higher if complemented with broader structural reform. That's a key message from those analyses. The second message is that, chances of IP success, are very narrow. It's a very stringent path. There are very stringent conditions to IP success. Is it possible? Yes, but really conditions are very stringent. And the reason why, one of the reasons, and that's my third point, one of the reasons why it's so stringent is that many countries do not have the fiscal space. Because there is, IP is more costly than structural reforms. If you're thinking about IP, you're thinking about incentivizing some sectors. So the fiscal space that is needed to do that, when you have the human capital aspect that you need to develop, you have the infrastructure, you have the social assistance that was discussed yesterday, that's a very tough constraint. And that constraint is more binding on low-income countries, unfortunately. I mentioned the debt vulnerabilities earlier, which compound those constraints. So very narrow path, and so we can discuss a bit more, but very narrow path to navigate.
Okay, thank you. So we've kept the kind of discussion at sort of quite a high level of abstraction in some ways. It's just started with sort of theory, if you like, policy theory. We've talked a bit about the long history. We've now spoken a bit at the regional level. I'm now going to turn to Tedros, who can hopefully sort of root this discussion in a specific country example. You've been, I suppose, engaged quite closely with Ethiopian policymakers in recent months, recent years, who have been grappling with a series of external shocks. Perhaps you can start by just giving us a bit of context on what's been happening in Ethiopia for those who haven't been following developments closely, and then we can talk a bit about some of the kind of policy measures that are being taken.
Thank you, Mark. Thanks for the invitation. It's really wonderful to be here and to talk about these issues. It's so much fun to talk after other panelists have discussed these issues, because I can highlight on some of the things that we have been passing through that relate to some of these points. Just a bit of very, very quick context. Ethiopia has been a very rapidly growing country, non-oil exporting, landlocked country, significant growth of 7 to 10% GDP growth over the past 10 to 15 years. So remarkable kind of story there to think about. It has been primarily public sector driven. I know we are in a balance of payments panel, but it's been public sector driven, fiscal dominated, public enterprise dominated growth story where there were repressive financial, and Constant has really pointed it out. Massive investments in infrastructure that led to growth, but that came at a macro cost, macro instability that trickled out to the balance of payments shocks that we've been facing. Of course, the commodity price shocks we have been facing, but above all that, the repressive financial sector policies, including very tight exchange rate policy, resulted in exporters facing large shocks, literally sort of taxing exporters at 50% because of the exchange rate used there. I'll, of course, come to the government's plan to industrialize and diversify exports. government embarked on building massive industrial parks in Ethiopia. That, to some extent, of course, created a lot of employment. And I'm going to talk about some of the shocks that we were talking about yesterday of trade policy shocks that affected the operations of these industrial parks. But these industrial parks were very costly, ultimately created debt problems. But structurally, as Constant said, its industrial policy is very expensive, and the results are not really as imagined initially. Of course, there were employment gains. These are global value chain firms that come to the country. They build their factories. They source none of their inputs from the local markets. Initially, when we attracted them, we anticipated they will use the local inputs. They don't use the local inputs. So we only have that cheap labor story that Rebecca mentioned about that labor wage differential that we just benefited from, which was also a big problem. Now, on top of that, the recent trade shocks. Actually, we were suspended from AGOA earlier, and we did some experimental studies to see how what some of the adaptation measures that could be used, which would be interesting, which if we have time, I'll talk about it later. Of course, another perhaps important story there is that with the improvement in commodity prices, coupled with improvements in macro management, so the past few years, we have been passing through significant macro reforms, including liberalization of our exchange rate regime. This past year, it was 1 year in June since the reforms have taken effect. Official exports doubled from 3 billion to 8 billion, which created a good buffer for exchange rate. Of course, we'll talk about it a little bit later, but let me just stop there and maybe follow up.
Yeah, well, maybe you can just again sort of expand a bit on what happened in terms of the exchange rate adjustment, the logic behind it, how the economies responded, and what some of the kind of ongoing challenges are.
Yeah. So some of the repressive measures that the government undertook to finance its large public investment, which, by the way, of course, more than the growth, it was proper investment. So it reduced poverty. It reduced poverty by half, absolute poverty by half as well. So really good results, but it had surrender requirements on private commercial banks on their foreign exchange earnings. It had surrender requirements on actual exporters on their export earnings. So current account restrictions on where imports could be used. But above all of that, the exchange rate, the official exchange rate was a crawling peg where, the central bank meant to keep foreign exchange cheap for the government's budget or spending. That resulted in, the parallel market rates going significantly high, and the rest of the economy largely using the parallel market rates, which had inflationary pressures there. So by the time the reforms were going to be undertaken, we had 100% premium official to parallel exchange rates. That has, after the reforms, of course, come down to about 8%, and slightly widening to about 10, 12%. But that represented, first of all, a very unfair distribution of resources, because it's only the government and very few business people who get to benefit from the official cheap exchange rate as importers. But the exporters were losing half of what they should be earning. So they were essentially subsidizing the government on that basis. So that was the distortion that needed to be corrected and created a shock. Yeah.
And so maybe we can just kind of look forward now. So, so the adjustment has happened. You've seen official exports pick up. What's the kind of like the medium-term plan? I suppose, that puts foreign exchange makes it more freely accessible, if you like. It's a fairer system. But one might have thought that this kind of long-term investment, this long-term public investment drive might have resulted in export growth. I mean, what's the kind of the plan, if you like, long-term plan for export diversification in Ethiopia?
So again, on the exports, and I perhaps slightly beg to differ with Constance on this one, that the IMF is not really going into the weeds of the behavioral aspects of what drives exports, supply side, grow. Those things are less the dwellings of the IMF's programs, of course, but I think that's where we need to look at. On the industrial exports, as I said earlier, it was very difficult because these were global value chains. Technological progress made it very uncompetitive for countries like Ethiopia. So they exist, but their trajectory in transforming the economy is low. Still, the industrial manufacturing, exports, manufacturing, the sector to GDP ratio still is about 5%. That has not moved significantly, despite all of that investment. But there is also another issue with the traditional exports themselves, right? The traditional exports like coffee. So again, concentration very much the case in Ethiopia as well. We have like 5 commodities representing 85% of total export earnings. So this, just looking at these commodities, and when you look at even the destination that they're going into, 60–70% of the products going to the same destination. So shocks in those countries are likely to be very difficult. So take, for example, coffee. If we significant part of that goes to Europe, and Europe now has sustainability standards that's becoming very difficult for Ethiopian coffee farmers to adhere to those rules. They are costly. So the study that we did, for example, looks at differentially looks at those farmers that have been able to comply with those, have benefited a lot, but these are sort of richer farmers than poorer farmers. The poorer farmers don't have that information. So this is like becoming a double-edged sword in the sense that we want these rules. This may be unpopular to say, but we may need to have that differential treatment for those export farmers. So export diversification is increasingly becoming difficult. Not diversification, but also maintaining what we had is very difficult. I mean, there are some positive stories. I'll come to that, but maybe also just.
You got one last positive story, and then I'll open it up because I can see people desperate to ask you questions.
Yes, positive stories that we have been. We have hydropower. Our energy is 95% hydropower. So we've been exporting energy. But some of these sustainability rules like CBAM requires clean energy production, which we expect could benefit countries like Ethiopia with clean energy to bring in more firms. So this recalibration could be positive. Bitcoin, miners are now coming to Ethiopia because of cheap energy, hydropower energy, and it's becoming a good, significant source of foreign exchange. And last year we exported electricity to the neighboring countries worth 300 million, which we expect to grow with our new dam. So those are some of the positive stories I can mention.
Perfect. Thank you so much. So I'm going to open it up now. We've got about sort of 25 minutes. I'm sure people have lots of questions. So I won't try and preface what anyone wants to ask.
Thank you very much, and I really enjoyed the discussion. It's really, really important to deal with shocks. The main difference between low-income and high-income countries over a longer-term perspective, 40, 50 years or so, is the fact that low-income countries have had many more downturns. So they have also had upturns, like high-income countries. But the main difference is the fact that low-income countries have had many downturns that they haven't been able to deal with. Hence the importance of resilience. Now, I think so. There are the 2 questions here, or 2 points here. I think exports are important and export diversification is important, but the main real driver, I think, is productivity. That's got to be the only sustained way of dealing with the crisis. Exports are important. Just an example of Sri Lanka, for example. The past crises have been dealt with through government deficit financing, not export revenue. So it wasn't really sustainable, and they had to go to an IMF again and again and again, like 17 programs, and they haven't really come out of the crisis in a different way. And I think that's the issue here as well, is that countries need to come out of the crisis in a very different way. Otherwise, they fall back into the same crisis again. And that's a transformative nature that needs to be emphasized. And I do agree that the IMF programs don't really have that in their programs. So they do set targets for revenues and for debt levels, for reserves and so on, which is really important. It doesn't say how you reach those. And which is probably a good thing as well, because it gives some leeway and some space for countries to think about how to do it. But countries do need to reimagine their economic management, because they need to come out of the crisis in a different way, in a more productive way. So that's in a sort of both the level of exports are important, that you don't rely on government deficit to come out of the crisis, but also the structure of an economy. Diversification as such. I mean, if you think about US wanting to have more garments firms in the country, they might diversify into garments, which is not as such a good prospect. The question is that you go into a more transformed economy, a more complex economy, and if you're more productive, you're both more resilient to crisis, and your exposure to crisis will also be different. And then therefore, the sum of the two, your vulnerability is less. Vulnerability equals exposure minus resilience.
Was there a question there? I'm winding you up. I'm winding you up.
Yeah. The question is basically, do you agree with that? That productivity is the key.
Do we agree Dirk's right?
Thank you so much for the great panel. I have two questions. One on Ethiopia. What's the feeling of the population and government 1 year after the liberalization reform? And do you think that feeling is which direction do you think that feeling is going to evolve over time? Do you think it's going to get more positive impact over time? My second question is on the IMF side. When there is a trade-off between growth and fiscal sustainability, because you mentioned that's an important trade-off, obviously one path has more uncertainty than the others. How do you position yourself as IMF? Uncertain path, promising, and possibly less uncertain. Thank you.
I'll ask a couple of questions as well, because the microphone is right there. So you mentioned, you're not expecting great returns from Ethiopia's previous investments now. And I think, lots of other countries in the region also made big public investment drives. What should our expectations be more broadly from that investment drive, particularly in the 2010s? We had the shock of COVID. So, are there any prospects that investment stock will start yielding better returns now in the future? And in terms of industrial policy, are there cheaper, better options than going on these big public investment drives? Thanks.
We've got. Should we take one more over here? Yeah. Why don't we stay at the back? There's Mark, one there, and then we'll take those ones and come back.
Hi, I'm Mark Boland from Red here in London. I've got two questions. One to Theodros. So I've heard, well, in Ethiopia, they did set the salaries very low in the factory parks. I don't know if that was in general specific, so they had a lot of problems with retaining the staff, which I guess affected productivity. Just your reflections on this and how they could possibly done that better. And then the other with Constante, I guess maybe because we talked about Benin yesterday, but Benin has the Glodjigibe Industrial Park, which is a very big project that's quite similar in some ways to Ethiopia, is that I think they want to source the cotton that they produce domestically. and use that to in apparel production. And just if you or well, if anyone else has looked at this, known if they've looked at Ethiopia as a kind of case to see what lessons they could draw on that. Thank you very much.
Which country was that, sorry? Benin. Okay, so why don't we start with you, Tedros? There's a few for you there. I think, you know, what the population feels, returns to investment, also sort of labour costs, I think was three that you might want to.
So with the feeling of the people in general about the liberalization of exchange rate, I think there was one sort of scapegoat, the IMF, that people blamed. Of course, they blamed the government for caving into, you know, IMF's pressures and everything. But this is a nuanced, complex story. It's very difficult for sort of the general public to understand the overall policy discussions. But the elites, there is a division, there is a sort of a Pan-African people who hate neoliberal or whatever kind of thinking, markets don't necessarily work, it's just the rules or whatever. That kind of sentiment is there to some extent. But I think the vast majority of, for example, producers, business people are very relieved because they've been very constrained with that story. So it's reached a position where they had to queue for a year and a half to get any foreign exchange access. So they're relieved. So that's one. I think on the public investment, again, I have to clear the nuance. It's the public investment actually really resulted in growth. As I said, 7 to 10% growth, very remarkable growth, poverty reduction. So we will continue to need to invest. Public investment will be needed on its ability to catalyze rapid private sector growth. There we have to rethink. So the industrial policy aspect of it has not been as successful. We'll need to make sure that the investment in, you know, skills and everything that we do is there to ensure that we kind of get the benefits from that. So more of a social thinking spending is something that I'm thinking to just get out of this, because it's not very clear what our comparative advantage is going to be in a few years' time with all of these very rapid change. So I'll just keep that there. I don't want to take too much time. So that's where I think I would separate those two effects. Public investment would want, we just can't say public investment is, you know, is bad or anything. On the salary, I think that's a very, very interesting question. We actually did an experimental study at the International Growth Center to try and address, but the general trend, even in the literature, is that in the initial years of building industrial parks, there will be high turnover anyway, because it will be a trial. For some people would like it, but as time goes by, firms continue to retain parts of those, and older firms tend to have a significant portion of employees that they have retained, which will help them achieve the productivity they need to increase their salaries as well. So most of the Ethiopian industrial park firms, especially the older ones, have increased their salaries significantly. More than double or triple the salary they started on. But another intervention that they have used and that has been successful, which was an experimental study, was retention bonuses. If the workers would stay 3 months, they would give them bonuses. It becomes very profitable. I mean, it's a win-win case for the firms and the employees, because if they stayed, they would achieve the productivity they would need to achieve, and also their salaries would increase. And so that's how a lot of firms dealt with the turnover issue. But as time went by, it became less and less. But that was a big story initially.
Thank you. I'm gonna bring Jose Antonio back in, who's sort of quietly waiting there in a Washington morning. Jose Antonio, do you want to reflect on any of what the other panelists said, or also I think Dirk's question? You know, should we just care about productivity rather than export diversification per se? And any other comments or reactions you'd like to make?
Well, thank you very much. I enjoyed the presentations. Let me start by saying that I coincide with Rebecca about the cycles of commodity prices. I actually have done research, empirical research in the late 19th century, and there are like 25, 30-year cycles of commodities, and the the upward phase is shorter than the downward phase. So that means that diversification is quite important, and being dependent on one commodity is very costly. Now, on the issue of export diversification, let me say that I think you have to think of different instruments for that purpose. I mean, the fiscal issue is not the important point. I mean, unless you want to give tax benefit, let's say, to the new export activities, which is not necessarily the only instrument that you have. I think even more important are two issues, which is the issue of technology in order to have productivity. So how you have technology transfer, how you design that system well, including through time being, at least a secondary innovation, a source of secondary innovations. That's one point. And the other is financing. I think having good national development banks is much more important than tax benefits, which is, I think, the development. That, by the way, is one of the major recommendations of the Conference on Financing for Development that took place in Sevilla, which thinks about both multilateral development banks, but also national development banks. And national development banks are very important for diversification, both in terms of lending, guarantees, and possibly some venture capital funds that, in order to co-invest in new economic activity. And finally, very importantly, who you partner with in international trade. And first of all, I really think it's important to regional integration, which is a topic that has not developed very well in Africa. It's much better in Latin America and the Caribbean, and I think it's very, very important. And the other is how you partner with the European Union, very important in this era of which partnering with the US doesn't seem to be the best option, let's say, but also China. What are the opportunities to export to China? I think is very, very important. Okay, thank you.
Thank you, Jose Antonio. I mean, that in many ways answers a question that I've had online around the role that macroeconomic policymakers play beyond reserve accumulation. You've talked about actually, well, it's a broader set of instruments, issues of trade integration, technology transfer, national development banks. Constant, I'm going to come to you. There was a couple of questions. One around the Benin example, Benin. If you've looked at that, I think there was also. I mean, there's this point on investment. I think Adil had a question as well around trade-offs. Over to you.
Yeah, trade-offs, fiscal and growth. The two questions or the 2 points are actually related because the experience of Benin suggests that there is some sequencing that could work when you have the micro stability going, and then you can be more ambitious when it comes to some of the more tailored reform that they are undertaking now. So on the fiscal and growth, I mean, there is a short-term tension, but eventually the two are not contradictory in the sense that even when you think about adjustment, we usually, there are three key words that comes to mind. There is the size, the pace, and also what we call the composition of adjustment. So the way you mitigate the growth impact of adjustment is to calibrate those three, depending on the country circumstances. If you're thinking about a country that has lost market access, where no one wants to lend to the country, of course, you will have to adjust faster, because what you need is to reestablish access to market and also lower the borrowing costs. Because what happens when your borrowing costs go down, you save towards investment in education and health. So very much, adjustment, there is a premium that comes with that. And then when it comes to the pace, same thing, right? If you have more investor confidence, or the situation is not that dire, you can go a bit more slowly. But there are cases where the crisis is so massive that you need to adjust a bit faster. And then importantly, the composition. right? And even if when you think within taxation, right? And Antoinette mentioned property tax and some of the feature of a property tax, which could probably have lower short-term impact on growth than other type of taxes. Think about spending composition. Certainly, I was very interested by the finding that social protection assistance has a very high multiplier during yesterday's panel. And you can think about infrastructure investment and so on. And where there is scope to improve the efficiency of spending, either through cutting corruptions or so on, those could also be ways to mitigate the growth impact of consolidation. And more broadly, one of the good way to think about it is to think about the framework, policy framework that you have in place, because ultimately you want to anchor expectations of investors, of your own people. When people see the path, it's easier to buy into it, and that also mitigate the impact of those adjustments. And Benin is one of the cases where indeed they've done quite a bit in terms of macroeconomic stability, and that has really lowered their borrowing costs. One of the first countries to reaccess capital market after the crisis. That has lowered their borrowing costs, which is allowing them actually to fund their school feeding program, right? Which also has premium in terms of education outcome and so on. So pretty much a link.
Okay. Rebecca, is there any of the questions you want to come back on?
Back a bit on Dirk's point as well, productivity, which I do broadly agree with, but I mean, one of the main arguments for wanting to move out of commodity exports is the long run argument that there's more scope for productivity gains in manufacturing. And we can debate that, and there are probably some aspects of the commodity market where there are a lot of productivity gains as well. But if you look back to the discourse in the 1990s, when a lot of African countries were sort of caught in this low growth equilibrium, if you will, that the discussion was essentially, right, how do we improve productivity in the traditional sectors? Clearly exchange rate devaluations weren't enough. It didn't tend to stimulate a big supply response. But then when you started looking at it, it's essentially like everything that we talk about in development policy, right? It's the roads, it's the port infrastructure, it's extension services, etc., right? That are part of what brings productivity to your export sector. And there, once you're in a crisis situation, there often is a bit of a catch-22 that all of those productivity improvements require investment, and you're in a position where that's particularly hard to attract.
I think we've got about 7 minutes, so I want to do one more round of questions, because I've been told that I need to give people plenty of time for coffee, and I can see that people want some coffee. It's warm in here. It's so warm. So I'm going to give people time for coffee, but I want to take one more round of questions and give everyone, each of my panelists, one last minute to respond as well. So we've got a question here at the front.
Can I make a comment rather than a question?
Oh, go on then.
I'm going to continue. I want to continue my shameless advertising of IMF research that I've been doing. That's what I was brought here for. The fund published a paper last year. Basically, it's called Economic Diversification in Developing Countries, and lessons from country experiences with broad-based and industrial policies. And what I think is useful about this paper is that it looks across, different, looks at countries ranging from, Vietnam to Georgia to Senegal, all over the world. And these are cases that are successful cases. And basically there are sort of 2 or 3 things that come through from those lessons, which you can't really, I don't think you can really get away from. And this is at a very high level, of course, there are idiosyncrasies with each case. One is the importance of macro stability, getting your inflation down and getting your exchange rate right and getting your fiscal, the fiscal space to make some of those investments that are critical. And those investments are around investments in infrastructure, education, And those are absolutely critical. And then the reforms we do, contrary to what some people might think, we do push in our programs a lot of reforms that are there, structural reforms to improve the functioning of labor markets and other product markets, trade integration and so forth, even though we don't have necessarily the expertise to implement them. It's not that they're missing. Other agencies are much better placed to follow through on those things, but that our programs are not just about, reaching this reserves target or getting your deficit down to this level. And then a lot on governance reforms. Very last point.
Coffee.
Sorry. Very last point. One of the other lessons is about industrial policy, about poorly targeted industrial policy, tax incentives, and over-reliance on, special economic zones. And here, just a quick story. 15 years ago, Antoinette sent me to Ethiopia to work in Ethiopia. And these guys, we were just talking about it before this session. They used industrial policy to diversify the economy, to develop a flower sector, okay? Cut flowers. Basically, 15 years later, what they did was they gave incentives to everybody, not just the first movers that basically took the risks. And that led to huge non-performing loans, and a lot of waste of public resources. And, without the associated technology transfer, without the other investments required, that sector hasn't flourished the way that one would have expected. So just a cautionary tale on industrial policy. Thank you.
Okay. Anyone else? Rattan,
Yeah. So
you need a mic. Yeah.
So is export diversification the only long-term strategy for building resilience?
Okay. So that well, why don't you all take that for 1 minute then at the end? Okay. So we've had the comment. Why don't you each answer Rattan's question now in 1 minute? Summarize your view on is export diversification the only long-term strategy for building resilience, especially in today's world with sort of trade tensions, etc. Jose Antonio, why don't you try that first?
I think following on my presentation, macroeconomic management to manage booms and busts is essential, but it has to be complemented with production sector policy. I prefer that term to industrial policy. And in my previous intervention, I mentioned the elements of that. That means a good development banking system to support the export diversification and the new sectors in general, some technology transfer, and really think about who are your partners, both regional partners, but also global partners that you want to partner with in order to benefit from their markets for export diversification. I hope that was 1 minute.
Rebecca?
I think I'd say yes as well, but I'd say that if that's the end goal, it doesn't necessarily mean that focus on and investing in your export sector is necessarily the key way to go, right? We haven't talked at all about agriculture today, but I mean the long run kind of history perspective would be that usually to be able to diversify, particularly if you want to industrialize, right, you need a very productive agricultural sector and integrated food markets and cheap food. So that might still be the better place to be putting kind of investment and resources potentially.
Maybe a very short answer would be it's a necessary but not a sufficient condition. And the reason why I'm saying that is that we haven't quite discussed the how. The devil is always in the details. So export diversification, of course, I think it's all good, right? The question is how, and linking to the discussion just now, one pitfall, and our research published last week showed that, is that IP, for example, lead to boost the sector to which they're oriented, right? If it's targeted in a sector, evidence find that there is some short-term benefit. But that often come at the cost of shifting resource from another sector into that sector. So the question becomes, and we discuss productivity, on aggregate, what is the aggregate effect? And that is very nuanced. And we would have to dig a bit deeper in those concepts.
Tedros?
Yes, I would say yes, conditional on the fact that the export diversification is a reflection on productivity growth, right? So I would just say that. But on the regional integration, on the partnership that was raised, and we've done a little bit of work on this, is that there is little complementarity between South. So local integration. So I would really focus on partnership with complementary trade structure. Otherwise, we maybe get our hearts broken again. This is what I'm saying. Thanks.
So how would I summarize that? I mean, I personally think that so some of the kind of long-term charts that Rebecca presented are fairly convincing that being overly reliant on a narrow set of exports is inimical to long-term growth and development. And I think most people on this panel would agree that it's both a cause of structural vulnerability, economic crises, requires careful management, a lack of export diversification, unproductive exports, if being locked into unproductive exports in Dirk's language is a challenge. And I think we're all agreed on that. I think what we're not going to solve in 75 minutes is how you go about doing that. And we've heard a lot that, trying to move away from simple narratives of if you put in place a more active industrial policy, export diversification will follow. I think what is clear, though, is that it's a useful North Star to be thinking about in terms of resilience, that if you're not thinking about productivity gain, if you're not thinking about hard currency earnings, then you're probably missing the wood for the trees when it comes to thinking about resilience. And just because there aren't easy solutions to that problem doesn't mean that we should lose sight of that problem. I think the final thing that we haven't really gone into detail today on, again, in a short discussion, is that clearly, and it's been hinted at, that global dynamics are shifting, whether that's through some of the trade tensions. We also talked about some of the technology that Tedros mentioned and the implications that's having for some of Ethiopia's bets on manufacturing. Again, this isn't an easy one to solve in 75 minutes. But again, I think it's one that you cannot lose sight of if you're having a sort of genuine conversation about how to build long-term resilience. So that's my summary. And I can see that there's almost cheers for coffee within the room. So I thank you so much, though, for all my panelists. A special thanks to Jose Antonio, who's joined us early in the morning from the US. Thank you very much to Rebecca, Constant, and Tedros, who have joined us in the room. And thank you all to your questions and participation. Thank you.